Hi, everybody. This is Alex Fensky, the lead agent for the Chicago Southland Homes team at Keller Williams, and I'm bringing you the November 2023 housing market update. I've challenged myself. I'm going to try to see if I can keep this to under 8 minutes. I just have so much to share. It's so fun. We're going to talk about where the real estate market is at in terms of supply, demand, how they're working together, prices, mortgages, and then a little summary. So that's what we're going to go through. Number one, let's talk about housing supply. What do I mean by that? I mean the number of people that are listing homes and the number of homes that are available. The number of people who are listing homes, if you can see by this chart right here, is down about 10% compared to last October, which makes it actually the lowest October that we've got on record. And my records in this system go back to 2008. So there's not been fewer homes listed in any October in the last 15 years. That's a trend that we've been seeing. I've been repeating myself about it for quite a few months. So now let's look at how many homes are for sale. Guess what? That number's down quite a bit even more, and is also still hovering around record lows. The number of homes for sale at the end of October was down 27% compared to last October. That is a huge change in just 1 year. And here's a fun fact for you. You can see that at any point this year, the number of homes for sale in our entire northeastern Illinois region has not exceeded 18,000, unless you count this 18,021. That's the highest it's been all year. What's wild is that prior to this year, there was only 3 months in the last 15 years that there was fewer than 18,000 homes. And those are all last year. You had January, February, and March of 21 were the only other months in the last 15 years where there was fewer than 18,000 homes for sale. And this year, there's not been more than 18,000. That's where we're at inventory-wise. If I annualize this trend, you can see it's just been going down, 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 and down. So that's what's going on with supply. Let's take a look at the demand side. I'm going to zoom back in here to my 3-year view. And on the demand side, we're looking at pending contracts. This is interesting. This is a seasonalized average. So meaning we're taking 12 months of data at a time. And you can see it started to bottom out. I've been talking about this for the last 2 or 3 months. Demand has been in free fall since right here, May of 2021. And it appears to have been flattening out the last 3 months. Pending contracts were only down 2% compared to last October. And in September, pending contracts were only down like 1.7% compared to last September. So demand is stabilizing. That's a big key point here. Housing demand is stabilizing in this regional marketplace. Closings have not begun to stabilize yet. Our closed sales are down in October 8.6% below last October. If we take the seasonalized trend, you can see it's still going down at a pretty good clip, down 22% last 12 months compared to the prior. But you can maybe just start to see just the beginnings of that flattening out, see contracts lead closings. So the closing data is going to lag the contract data. We're 3 months into the contract data sort of flattening out, and we're just starting to see closing data maybe doing that. So I think we're going to see closed sales stop dropping pretty soon here within the next 2 months. Prices. This is the crazy part. You would expect that with all this stuff going on with mortgages, that prices would be really kind of getting hit hard. I have to move my screen to show you that prices started to come back up. We predicted this a couple of months in advance. We talked about this last 2 months. Prices have been up a little bit on a 12-month basis. But if you look at monthly data, we've been up 7% over the prior year, the last 3 months. August, September, and October, prices have been up 7% compared to those same months the prior year. Prices have turned back up, and I'm going to show you why. The reason why is that the balance of supply and demand in this marketplace still has not softened at all. We have, depending on how you measure it, 1.9 or using a seasonalized number, 1.8 months of housing supply. If I were to show you where a balanced market is on this chart, where it's not a seller's market, it's not a buyer's market, there's just enough homes available for everybody who wants one, I actually couldn't show it to you on this screen because it's 6 months of supply, and that would be up off the top edge of the screen. That's where a balanced market would be. And we haven't been in a market like that since debatably about September 2013, which was just the early edge of the recovery after the Great Recession. We've been in a seller's market that whole time. It's been 10 years of a seller's market, and it's not going the other direction at all yet. Not at all. That's why prices are going back to increasing, because of the fact that there just aren't enough homes available for the people who need one. Let's talk about the people who need one. Talk about mortgage rates. So I'm going to flip over to my mortgage news daily. This is where I get my mortgage data. You can see right now the 30-year fixed rate mortgage is at 7.46%. It's down off of a peak. It actually came up and crested over 8% for the first time since October of 2000. 23 years ago was the last time mortgage rates were as high as they were about a week ago. They dropped a half point in the last week, but they've still not been even near 7 in terms of the 30-year fixed in quite some time, and prices are still going up despite that. That is worth noting. Your FHA and VA loans are clocking in quite a bit lower. Those are right at about 6.82, 6.83 on the average. And your 15-year fixed is right in that range as well. The 5/1 ARM, this is kind of a lie, because that is what pricing is coming in at, but with several points. I don't mean like 2 or 3, like with 4 or 5 points or more. It's absurd. So the 5/1 ARM is, there's really no point in doing it right now. And that's because of the way that bond yields are working in the marketplace. It's kind of wild. Last point on finance, let's talk about the Federal Reserve meeting. So the Federal Reserve met last week, and at their last meeting, they were thinking that at this meeting, they would bump the rate another quarter point. They ended up deciding not to, because they've seen some encouraging news with inflation. It's continuing to moderate. It's not where they need it yet, but it's trending in the right direction. They're happy with the progress, and they did not raise the rate again. They've said they're meeting again next month. They've said they're not even thinking about rate reductions. What they're looking at is either holding steady or bumping up more. If inflation starts to run hot or economic growth starts to get crazy again, then they're going to bump the rate and make it higher again, try to slow things down, cool it off a bit. We shall see. So what to do about all this? Well, sellers be encouraged that finally, after a year of flat prices, we have 3 straight months of price increases. So for sellers, that's kind of good news. It's still, I don't feel super confident in all that. They are going up, but I still want you to price against active listings more than against closed sales, because the market is changing. When it's moving around in real time, you don't want to look at stuff that closed a month ago that someone decided on 3 months ago, or something that closed 6 months ago that someone decided on 9 months ago. You want to look at what your active competition is right now. That's the most important in a market that's behaving in this way. Buyers, I'm very confident in saying this, a home bought today will be more affordable than a home bought tomorrow. We've got people doing interest rate buy downs, getting seller credits to help out with that, and looking at what looks like objectively pretty big chunks of money at the closing table. But you turn around and realize that you can start out with an interest rate that starts with a 4 or a 5. And you look at how long it's going to take you to make that money back, or to save that money back, if you will. And the break-even time periods are just a few years. So if you plan on being in the home for a pretty good amount of time, a rate buy down may get you exactly what you need. Work with a great lender, work with us. We'll connect you with a great lender. But most of all of this information is still very general in nature. I'm talking about the entire greater Chicagoland, northeastern Illinois area, and real estate is hyper-local. So contact me. Drop a message, send us a chat, whatever you want to do. But get in touch with me to talk about your specific real estate needs, your specific properties of interest, and things like that. And that way I can give you specific advice. Thanks a lot. We'll see you next month.